Hello, Mike Ingle with Renanza Realty Inc. with a quick Bank of Canada rate drop report. The Bank of Canada has just made a significant move, lowering its target for the overnight rate to 3%. The bank rate is now set at 3.25%, while the deposit rate stands at 2.95%. At the same time, the bank is finalizing the normalization of its balance sheet, marking the end of quantitative tightening. Starting in early March, the bank will begin purchasing assets again, gradually stabilizing and growing its balance sheet in line with economic growth. The bank is also preparing to resume asset purchases to complete the normalization of its balance sheet. Starting in early March, term repo operations will restart, with sizes ranging from $2 to $5 billion initially and increasing over time as necessary. Later in the year, the bank will resume purchases of Government of Canada Treasury bills, with the exact timing depending on the evolution of settlement balances. Government bond purchases are not expected until at least the end of 2026, based on current projections. Domestically, the effects of past interest rate cuts are becoming increasingly evident. Consumer spending and housing activity have picked up and are expected to maintain their momentum. However, business investment remains weak, and the outlook for exports depends heavily on new oil and gas capacity coming online. The labor market, though improving, remains soft. December's unemployment rate stood at 6.7%, but recent job growth suggests a positive trend after more than a year of sluggish employment expansion. Wage pressures, once stubbornly high, are showing early signs of easing. Looking ahead, the bank expects GDP growth to strengthen in 2025. However, with reduced immigration targets leading to slower population growth, the overall pace of economic expansion will moderate. GDP grew by 1.3% in 2024, and the bank now projects growth of 1.8% in both 2025 and 2026, slightly above potential growth. This means that excess supply in the economy will gradually be absorbed over the next 2 years. Of course, there are risks to this outlook. While inflation is stabilizing and the economy is slowly gaining traction, external threats remain. The most significant of these is the possibility of a prolonged trade dispute with the United States, which could disrupt supply chains, raise costs, and weaken GDP. While no new tariffs have been imposed yet, the potential for future restrictions remains a key risk factor. On the inflation front, CPI inflation is hovering around 2%, though volatility persists due to temporary tax suspensions on certain consumer products. While shelter price inflation remains elevated, it is slowly easing as expected. Broader indicators, including surveys on inflation expectations and CPI component price changes, suggest underlying inflation remains close to the bank's target. The forecast maintains that CPI inflation will stay near 2% over the next 2 years. Against this backdrop, the bank's governing council has opted to cut the policy rate by another 25 basis points, bringing it down to 3%. This marks a substantial cumulative reduction since last June. Lower interest rates are already stimulating household spending, and the bank expects the economy to strengthen gradually while keeping inflation near its target. However, policymakers remain cautious. Should broad-based trade tariffs be introduced, Canada's economic resilience will be tested. The bank will closely monitor developments and assess their implications for monetary policy, economic activity, and inflation. Its commitment remains firm, ensuring price stability for all Canadians. Domestically, the effects of past interest rate cuts are becoming increasingly evident. Consumer spending and housing activity have picked up and are expected to maintain their momentum. However, business investment remains weak, and the outlook for exports depends heavily on new oil and gas capacity coming online. The labor market, though improving, remains soft. December's unemployment rate stood at 6.7%, but recent job growth suggests a positive trend after more than a year of sluggish employment expansion. Wage pressures, once stubbornly high, are showing early signs of easing. Today's announcement comes amidst a period of heightened uncertainty. The global economy is expected to continue growing at a steady pace of around 3% over the next 2 years, with U.S. economic growth revised upward due to strong consumer activity. However, the Eurozone faces competitiveness challenges, and while recent policy actions in China are supporting demand, structural hurdles remain. Since October, financial conditions have shifted, with U.S. bond yields rising on the back of robust growth and inflation persistence, while Canadian yields have declined slightly. The Canadian dollar has depreciated significantly against the U.S. dollar, largely driven by trade uncertainty and a stronger U.S. currency. Meanwhile, oil prices have remained volatile, sitting about $5 higher than previously forecast. These actions signal a new phase in Canada's economic trajectory. With interest rates lowered, inflation nearing target levels, and growth poised to pick up, the Bank of Canada is taking measured steps to maintain stability and support a steady economic recovery. However, as always, uncertainties remain, and policymakers will continue to assess and adapt to emerging risks in the months ahead.